So, all right. So you have a system in place, right? Where you spoke to me about it over the phone that UNCs to use. Can you just explain that? Like as far as like you buy a home, then you take the cash from the home, you buy another home. Like what's your blueprint?
So yeah, and that's kind of like what allowed me to like really blow up as far as like in real estate. So it's basically the system is you try to cash out on your property as soon as you're done renovating. So just to like run a quick math, let's just say the house is worth 300,000, you pick it up for 100. Let's just say it needs 50 in renovations. So it's like originally when I would go to a hard money lender, I would just tell them, look, I'm buying the house for 100, I need 50 for renovations. And they'll give me the 90,000 on the purchase because it's 10%. And then they'll give me the 50,000 for the renovation, which was cool. Now I was able to renovate the house. But then eventually I got a little smarter. I was like, wait a minute. These are the hard money lenders. They're willing to give you 70% of the value. So if the house is worth 300 and they're willing to give me 70%, that's 210. So why am I just pulling out 150? Let me just pull out this 210 right away. So that, so now if you renovate it for 50, but now you're not taking 50 for renovation. Let's say in this scenario, I'm taking 110. Now finish up the house with the 50. You get that difference. So by the time you're renovating the house, you're pretty much already cashed out this money. And then you have the two options with your house. You can either flip the house, and if it's worth 300, that means you're flipping it for 300. Or you could just do a cash out refi, which will be at 75%, which on the loan, instead of being 210, it might be, let's say, 220. But you're already cashed out, so you're not really cashing out. You're just more like what I call parking the house. And the most important thing about this property, it needs the cash flow. I mean, cash flow is like the most important thing. So if you follow the cash flow, then, and you do the system, you're going to be all right.
So hard money lending, can you talk about that? Because people might not be familiar with, because people know about traditional bank loans, mortgages and stuff like that, right? But people don't understand, I don't think a lot of times, that you can get financing for a home outside of a bank.
Yeah,
right?
Like when I heard the word hard money, I'm thinking
like loan shark.
Loan shark. It's got to be this guy with a suit, hair slicked back, and he's like, I can give you some money. Like, what is a hard money lender?
So a hard money lender is a private lender, and they're an asset-based lender, meaning that they're not really focusing too much on your personal income credit. They're really focusing on what property you're buying, what's it worth, how much are you going to need, and do those numbers make sense? And for them to make sense, different lenders have different rules. I have lenders who they're willing to go 75% loan to value. There's lenders that are willing to go 70. Some, they're really cheap. They only want to go, let's say, 55%. So it depends what lender you get. But the most important thing about them is like they're not focusing on your
credit.
On your credit, you got at one point, I think like the first hard money loan that I took out, my credit score was like a 585, which is trash. So and at that property in particular, I had no choice but to go through a hard money lender because I was trying to go through like a regular conventional bank, and they already had loaned me on a couple of properties, but I ended up getting a state tax lien on my credit, and that kind of destroyed my credit score. So I was able to reverse it, but to reverse it was going to take a few months, and they weren't going to wait a few months, and I couldn't wait a few months. I needed to do the deal right away. So that's when I was introduced to a hard money lender, and they made it happen.
So in that process, right? Because I'm assuming like hard money lenders, not many of them look like us.
No.
Were there some like discriminatory setbacks or anything like that?
You know what? Coming from the inner city,
Yeah.
I've learned in this business that sometimes we tend to be racist ourselves. It's kind of like, you grow up in the inner city and it's like everyone around you is like a minority. And like when you see someone who's not a minority, they're like either a police officer or like you see them on TV, like the politicians. And then you hear all these things of like, situations, especially in the inner city dealing with cops. It was like you put in your head like, oh man, everybody's, they're racist, they're going to be racist. And you kind of come in already defeated, basically thinking that they're going to be racist against you. And that's not the case. It's like most of the people that I would say that financially have helped me out through loans have been white people. So, that whole concept of like, it's going to be all racist, it doesn't work. I will say this though, especially starting off. Inner cities, they're pretty dope now. Everybody wants to invest in them. But you go back, they were the first ones to take the hit. And going to a bank, nobody wanted a loan in inner cities. It's like when I first tried to do cash out refis, lenders would say, oh yeah, we're willing to go 70%. And once you submitted the application and throw in the zip code, they'll come back and say, like, we can only give you 60. It's like, why only 60? It's like, oh, because where you're located is a really high crime area. So it's a higher risk for us. So they chop it down.
So if anybody's not familiar with Jersey, you're from Patterson, Park,
Yeah,
right?
Patterson.
All right, so Patterson, Newark, East Orange, South Orange, Jersey City, any other place I'm forgetting?
That's southern Jersey. Right?
I mean, but like north, I'm talking about Northern Jersey.
No,
right?
yeah, you got your Jersey City, you have Elizabeth, you have Newark, you have Patterson, you have Passaic. You know, it's a whole bunch, and you have other like smaller
towns and stuff like that. All right, so but Jersey's it's like all places, right? Where you have the haves and have-nots, right? So there's very wealthy neighborhoods and there's very poor neighborhoods, right? Yeah. So, but like all places in America, the poor neighborhoods in Jersey are changing now, right? So Jersey City, we was just in Jersey City. That's not even like that's completely different, right?
Yeah, you see the skyline, it kind of looks
like Jersey City is completely different. They're doing a lot of development in Newark right now.
Definitely, yeah.
Patterson, where you're from, gentrification's coming.
It's coming, yeah, definitely.
So
it hasn't hit like to the extent with Jersey City and Newark. And we always say the reason for that is because Jersey City and Newark, they have really good public transportation, like trains that go into the city. So that allows for that to happen a lot quicker. For us, we have buses, but we don't have like any trains that are mass transit like that. We have one that goes into Newark, but very few people use it. It doesn't have like that appeal if someone could just go and grab the train and get out there.
So what are the appeals, disadvantages, advantages? Because we hear this a lot, right? Where it's trendy, it's like buy your block, buy back the block, right? So you actually have done that. You guys are actually doing that in real life. So, because I mean, you couldn't at this point. You can invest anywhere. You can invest in the suburbs. You can So for you personally, why is it beneficial to invest in the inner city, and what are some advantages and disadvantages in the inner city?
Well, for one, when I got into real estate, I wanted to get into rentals. So you're not going to go into the suburbs to do rentals because it's like the money's not there. And I've read a lot of books, and before I even got into like real estate. And one key thing that I always read in is like all those other like investors who wrote books will always say, which I agree with it too, is like go into like the tough neighborhoods, but the good parts of the tough neighborhoods, and then you're gonna do all right. So, but yeah, the suburbs you're not gonna make money. Where you're gonna make the money at when you deal with rentals is gonna be what the rentals are at, which for the most part is gonna be the inner city.
Yeah, and that goes along with like zoning issues, right? I would assume like in the suburbs, people's homes aren't zoned for 2-family, 3-family a lot of times.
They design that way. They design one families, and they'll have their few multi-family complexes, but you're talking about $1 million properties, then you start off, that's just not realistic.
Right.
Okay. All right. So one other question that I wanted to ask you. So, okay. Can you just break down your first deal? Because I think that's the hardest part that people, it's like all things in life, right? The hardest thing to do is to start.
Yeah.
Once you start, then you can you just explain your first deal, your first investment deal?
Yeah, so, going back to that chart where, I wrote down 2004.
Yeah, 2000, yeah.
It's like, in my mind, 2004, that's when I said, okay, I got to get into real estate. So, went into real estate, but as soon as they ran my credit was kind of like shot. So, I had to start working on fixing that credit. By the time I finished fixing the credit, it was like 2005, 2006. Started working with a real estate agent, and that's when, I said I wanted to get that 3-family so I could live for free in one. That didn't really work out too well. She couldn't find me anything, so I ended up getting my license. Got my license, but 2007, I ended up getting fired from my job. So now, couldn't get into like basically real estate investing. So took that as an opportunity to I had my license. Let me just do real estate and let me learn the business as a realtor. So let's just fast forward when I ended up getting my first property, which was 2011. That was a short sale. I put the offer like in 2010. All right, now this deal, when I put in the offer, I put an offer of 150. I qualified. I was good to go.
Yeah. The
bank approved it for 228. It's not much of a difference on the mortgage, but it's like when you're like really right on the borderline, that made that made a huge difference. So I couldn't get the loan. I mean, I went to like 8 different banks to get like a loan. Everybody said no. So, which is a thing that I tell people now all the time. Like, listen, when someone tells you no, that just means it's not a yes right now, but find out what do you have to do to make that a yes. That yes could happen in a couple of days or could happen in a couple of years, but like definitely find out what you need to do so you could get it corrected. Did that when went back to like one of the guys, he kind of broke down to me why I didn't qualify. It's like I had an auto loan, I had a lot of credit cards maxed out, and I also had a huge IRS bill. So it's kind of like I had to kind of maneuver all the money, make a payment plan with the IRS instead of paying them in full, pay down some credit cards, pay off a car, and did all that. And then I had like basically like the money and the means to get the first property. It was a game changer for me, the first one, because it was a 4-family house, and it was all rented through Section 8. Mm-hmm. Now, what's crazy about that I went, I was telling friends, family members about it, and everyone was basically telling me like, nah, don't do that. 4-family house, that's crazy. You're gonna be dealing with tenants. It's gonna be a headache. Get the 2-family with the attic in the basement. Which in my mind, I'm like, well, that's a 4-family. But then for that though is that, let's say in Jersey, 3-family. Once you have a 3-family, you have to deal with the state, and they come and inspect your property every 5 years. And most people don't like dealing with that. So with 2-family, you get no inspections, and now you have the attic, you have the basement. It's fair game in Patterson, attics and basements, for some people, for those who are willing to take the risk. But for me, it was a game changer because it was like a 4-family house. 2 apartments paid the mortgage. The other 2 apartments were basically for myself. So now that's basically about $3,000 per month that I was making on that property. That's about what I was making for my job as working as a realtor. Mm-hmm. So now it's kind of like, wait a minute, if I was happy with $3,000, I could pretty much say, let's forget this. I'm done. I'll retire. I'm gonna stay home chilling. But that, that opened up my mind. I just got aggressive. I'm like, wait a minute, now I need to get another one. So now what do I have to do to get the other one? And started like strategizing and figuring out ways. It was the time was also perfect too, because it was like, during that time, nobody wanted to jump into real estate. I mean, I would go to barbecues and I would try to convince people to buy and to get an investment property. Everybody thought it was just after a commission. Like, nah, you just want to sell that house. And it's like, nah, man, like, this, you're gonna make good income off of this house.
So you bought your first investment property in 2011.
Yeah, 2011.
Took the equity out of that and then bought another one and then kind of just parlayed it from there.
No, actually, it didn't take out the equity on that one. It's like that still wasn't in my mind. I still didn't know about like cash out refis or anything like that. It's got the first one. The game plan was to just save up money. I'm making $3,000 per month, so if I don't touch those $3,000 in a year, that's close to $40,000 I was gonna have. Mm-hmm. So it was just kind of like saving up. And then like a year later, what happened was there was a property that I had put in an offer for a client of mine. And we put in an offer on a 4-family for $150. He was gonna buy straight cash. Months passed by. He hits me back up because it was a short sale. He got desperate. He couldn't wait. He said, find him something else. Found him a 6-family for $200. A couple of months passed by. The realtor that was selling the house, she calls me up and tells me, hey, listen, we finally got the approvals. Your client's still interested. And I was like, yeah, definitely. No, he wasn't, but I figured, make that commission, sell it to someone else, right? Yeah. So he's like, no, it's kind of weird, man. But it's like, the house only appraised for 75. So I was like, oh, what does that mean? She's like, 75 is basically that's what your client's gonna have to pay. So I was like, okay, great, yeah, let me give him the good news. So we went back, got on the computer, opened up an LLC, and started making phone calls. I had no money, so it's saving those those $3,000 per month. It's like the house that I bought needed some work, so I spent some money on that, and I wasn't managing the money right. So started making phone calls, I ended up borrowing some money, had some money saved up, used that to kind of renovate the house, and that's how I ended up getting my second property. I ended up getting this 4-family for $75,000. And that's the first one where I sort of got like a cash out refi on it, because like 8 months later, I was able to go to a bank and they gave me $100,000 loan on that one. So I was able to get back my money on that.
So your company, you said you filed an LLC, so your company became your client. You became your client.
Yeah, basically.
In a sense, right?
Yeah, in a sense, it's like the bank didn't care who purchased the house. They just wanted the 75.
So what are some of the benefits of putting a house or property in an LLC?
At that time, the benefit was it was a requirement. So it was a business deal. Like it's to for one thing, I wanted to make sure doing research and stuff, and it's like getting multiple properties. I had this thing in my head that I read, like, if you get a different LLC for every property, that's going to limit your liabilities. So I kind of went that route. Mm-hmm. But now I just keep a couple of LLCs for my properties. There was a time when I was actually opening up an LLC for each property. But then after a while, gets kind of, it's like a headache. You got to follow these paperwork and everything for it. I was like, no, I'm not doing that. Just keep good insurance on your house.